Welcome to the Tim Booker channel, where wisdom is shared. We wish you a pleasant listening experience. Today, I'd like to introduce a book called Mastering the VC Game. It's a book that teaches entrepreneurs how to secure investments. Let me start with a story. In ancient China, there was a scholar on his way to the capital for an examination. Along the journey, he met a young lady. After a conversation, the young lady was impressed by the scholar's talents and gave him some money to help him on his way, even offering herself to him. One night later, as the scholar was about to leave, the young lady held his hand and said, "If you become the top scholar in the imperial examination, you must come back to me." The scholar solemnly agreed, and then he continued his journey. The young lady instructed her servant to remember the scholar's name. The servant, puzzled, asked, "Isn't he the 50th one? Haven't you been deceived enough?" The young lady sighed and said, "Well, we have to keep trying because there will always be one who succeeds." As you may have guessed, the young lady represents venture capitalists, and the scholar represents entrepreneurs. This story illustrates that successful entrepreneurs are rare, and investment capital is often at risk. Entrepreneurship is a high-risk game for both parties. Now, let's continue the story. After the scholar left, he instructed his servant to remember the young lady's name as well. The servant asked, "This is already the 99th one. When are we going to the capital for the examination?" The scholar replied, "Well, isn't becoming a high-ranking official all about money? Since there are so many devoted women, why bother with the examination? You can see that there are many fraudulent entrepreneurs among us who specialize in securing investments to live comfortably for a while." In any case, the relationship between entrepreneurs and investors is like that of the scholar and the young lady in the story. One provides the funds, and the other contributes the effort, both striving toward a common goal. We are currently in an era of entrepreneurship for all, with increasingly favorable conditions for startups. In the past, if you had an idea, you had to fund it yourself or borrow from friends and family. Failure could lead to financial ruin. Nowadays, there are dedicated investment institutions actively seeking promising startup projects. If your project is chosen, you will quickly receive initial funding, along with a range of support for subsequent rounds of financing, like Series A, B, and C. You might wonder, I'm not an entrepreneur, so what use is this book to me? Well, in this age, whenever you want to accomplish something, seeking help from strangers is a necessary skill. Fundraising is a typical example of seeking help from strangers. From the initial search for investors to successfully securing their support, there are numerous techniques and methods involved. These methods, used to persuade investors, can also be applied to persuade others. Are these methods worth studying for all of us? The author of this book is Jeffrey Busgang, a successful serial entrepreneur and a renowned angel investor, a rare expert who has experience as both an entrepreneur and an investor. In this book, he provides an in-depth analysis of the investor community, explaining how investment institutions operate, their preferences, how entrepreneurs should persuade investors, and how entrepreneurs should protect themselves. Now, let's delve into the content of the book from the perspectives of both investors and entrepreneurs. First, let's talk about investors. Many people think that investors are wealthy individuals who sit on high chairs, selecting entrepreneurs as if they were models on a runway. It feels like entrepreneurs are objects of selection, and investors are the dominant party. In reality, the situation is quite different. Professional investment firms are independent companies that need to find partners who are typically very wealthy. Together, they form a fund for collective investment. Their primary sources of revenue are management fees, usually around 2% of the funds they manage. These management fees cover staff salaries and daily expenses. The more funds they manage, the higher the management fees they collect. As a result, many investment firms actively seek more partners to strengthen their financial position and increase their management fees. Another significant source of income for investors is profit sharing. For example, if a company they invested in performs well, gets acquired by a larger company, or goes public successfully, they receive a share of the profits. So, you can see that the main business of investors is to find suitable entrepreneurs. Entrepreneurs are like their lifeline. The performance of investment firms depends entirely on entrepreneurs. Investors come to the aid of entrepreneurs when they need rapid growth, market entry, technological upgrades, or product optimization in exchange for a share of the startup company. In essence, entrepreneurs and investors engage in a transaction. It's like setting up a street stall, selling a portion of your goods, and exchanging it for money. It's a fair trade, and there's no question of who's taking advantage of whom. Therefore, when entrepreneurs communicate with investors, there's no need to be overly deferential or submissive. You can confidently present your ideas, make your demands, and conduct thorough investigations of the investors. It's a two-way choice. If the demands made by investors are unreasonable, entrepreneurs have the option to reject them and look for another investor. The key is to have the right mindset. You might find it strange how these investors make investment decisions so quickly, especially when they are not familiar with the entrepreneurs. How can they confidently invest large sums of money after knowing each other for just a few weeks? How do they make their judgments? This is where the skill of investors comes into play. They are usually energetic and well-rounded individuals. Although their knowledge of each specific field may not be very deep, they can conduct various research or seek expert advice to understand an industry and a project. Many investment institutions also hire seasoned industry experts as consultants. Of course, there are times when external factors can lead to mistakes. Let's take a common example from our surroundings, the O2O industry. Initially, it seemed promising, with many believing it was a better trend than group buying from years ago. It was expected to last at least 3 to 5 years. However, it quickly became saturated in the latter half of 2014, with a small number of companies rising rapidly. By 2015, various internet giants entered the market, and the entire industry became highly competitive. Traditional and internet companies alike rushed into this sector, pouring money into promotions, QR codes, and user acquisition, resulting in a lack of profitability. By mid-2015, the industry reached its low point due to the cold economic climate. Many investors were left in dire straits, and businesses faced financial difficulties. Investing is not easy, and investors must constantly monitor developments in various industries, learn about new concepts, build their own brand, attract more entrepreneurs, and guard against deception. It's a complex and ever-evolving industry. Entrepreneurs often face difficulties in the early stages, and some believe that they should secure funding as soon as possible, often accepting money without proper evaluation. However, this is a common mistake, as not all funds are suitable, and accepting them without consideration can have severe consequences. Consider a typical scenario. John identifies a startup project, forms a team, and is ready to make a significant impact. At this point, a traditional industry boss sees potential in John and his project, offering him $1 million in exchange for a 60% stake in the company to get things rolling. Initially, John doesn't think too much about it and accepts the offer, thinking that as a first-time entrepreneur with no experience or capital, he shouldn't turn down the money. He takes the $1 million and starts running the company. However, a year later, when the company starts to gain traction and he's considering raising funds from the capital market, he realizes that the initial ownership structure is not conducive to attracting investment. He approaches the industry boss and asks to renegotiate the ownership arrangement. At this point, the industry boss is unwilling to make any changes and proposes that John buy back 60% of the ownership for $5 million. John finds himself in a difficult situation, torn between the need for funding and the company's survival. This scenario is a typical example of the consequences of accepting funds without a clear long-term strategy. Today, there are both legitimate and questionable investment institutions. Entrepreneurs must carefully select the right partners to work with. How can entrepreneurs find suitable investors? It requires significant research. First, it's crucial to understand that the most significant cost for entrepreneurs is their time. When an entrepreneur identifies a new opportunity, other entrepreneurs are likely also competing in the same space. If you miss the window of opportunity, even a great project can turn into a poor one. Time is the most precious resource for entrepreneurs, and it's crucial to save it. The author suggests that entrepreneurs do their homework in advance and manage their fundraising itinerary. First, you need to screen the investment institutions. These institutions often have specific preferences for the types of projects they invest in. Some may focus on clean energy, others on cutting-edge technology, some prefer content teams, and others concentrate on artificial intelligence. They all have their areas of expertise, and not every investor will be interested in all business proposals. An investor's cognitive capacity is limited, and they cannot be experts in all areas, even with strong support teams. Therefore, entrepreneurs must focus on a specific target and work diligently to achieve it. Additionally, you should prepare your online presence. Many entrepreneurs only have a single idea in mind and little else when seeking funding. However, this approach is relatively inefficient. Of course, there are exceptions where funding is secured in just 5 minutes, but these are rare occurrences. Entrepreneurship is like taking a leap off a cliff, and entrepreneurs should assemble their airplane before hitting the ground. Investors act as the wind that keeps you flying a bit longer once your airplane is assembled. In other words, entrepreneurs must take the first steps and start working, with or without initial funding. Regardless of whether you secure funding, it's essential to start building a track record before seeking investment, which is the right approach. For example, many investors are interested in understanding how much an entrepreneur has personally invested in the venture. Did you use up all your savings, or did you hold back some funds? This is an effective way to test the entrepreneur's dedication and passion. Investors often conduct online research about entrepreneurs, so it's essential for entrepreneurs to prepare their information and maintain a visible online presence. Finally, the timing of fundraising is crucial. Investors are often extremely busy, with many of them working long hours. The schedules of investment managers are meticulously planned, and entrepreneurs should seek introductions and appointments through their network connections rather than randomly approaching investors. This is much more efficient. Here, I'd like to digress for a moment. Many people assume that investors are highly rational and equipped with comprehensive research systems. Whether you're a stranger or introduced through a mutual contact, they believe there shouldn't be much of a difference. However, that's far from the truth. Investors are human too, and when it comes to providing capital, they often rely on mutual acquaintances to learn about you. This is a necessary step. One of the most significant criteria for investment is the individual involved. This is a universally recognized standard within the industry. As long as the individual is reliable, even if the project fails, investors will learn together and start anew with you. Conversely, if someone's character is questionable, it doesn't matter how promising the project is, it won't be of much use. Therefore, it's crucial to build a good reputation over time and make friends with influential people. In critical moments, a simple phone call from someone else could help resolve urgent issues. If you don't have any acquaintances who know investors, you can also seek the help of financial advisors or intermediaries known as financial advisors, FAs. These financial advisors don't invest their own money, but they have extensive networks in the investor community and a deep understanding of the entire fundraising process. They can assist entrepreneurs in planning the entire agreement process and significantly improve the efficiency of fundraising. Of course, if you successfully raise funds, you will need to pay them a fee. Each person has their area of expertise, and it's always more efficient to let professionals handle specialized tasks. Now, let's discuss what preparations entrepreneurs need to make from their perspective to win over investors. Suppose you have a promising project that's just getting started, and you've successfully scheduled a meeting with an investor. What do you need to do? The author highlights 3 crucial points. If you excel in these 3 areas, you'll have a much higher chance of success. The first point is to make your intentions clear. You might think it's unnecessary because, as an entrepreneur, you obviously know what you're going to do. But don't underestimate the importance of this step. The challenge is that many startup projects don't have a clear profit model in the early stages. It's not just that investors don't know, even entrepreneurs themselves are often unclear. Typically, people see only a general direction. For example, you create a product that attracts a lot of traffic. So how will you monetize it? Many entrepreneurs don't think that far ahead and believe that once they have the traffic, monetization won't be a problem, and they can figure it out later. However, investors don't see it this way. They are most concerned about how you plan to monetize your venture. You might say, "I'll sell products." But then comes the question, what products will you sell? How will you control their quality? How will you manage the supply chain? How will your products stand out? Does the cost of acquiring traffic match the profit from transactions? As you can see, there are a host of issues, and these are the most critical ones. Therefore, when describing your vision as an entrepreneur, it's crucial not to rely solely on emotion. You need to consider the investor's perspective. After all, investors will eventually want to see returns on their investments, and investment firms will have specific exit strategies in mind. You might say, I haven't thought about these fine details. These are issues for the later stages. Right now, the primary concern is to build traffic. That's not necessarily a problem because, in the end, no one can predict what will happen in the future, and not all investors will think so deeply. In this case, your main focus as an entrepreneur should be on whether your endeavor aligns with current trends. This is crucial because predicting trends is the top concern for investors. There's a book called Superforecasting that discusses various methods for improving your predictive abilities. If you're interested, it might help you become better at predicting trends. So why is it so important to predict trends? It's because of the nature of the investment industry. Investors won't invest in yesterday's projects because those have no relevance to their current situation. New opportunities are always built on top of previous ones. They also won't invest in today's projects because by then, many others have already done so, leading to fierce competition. Investors don't invest in tomorrow's projects either because the best prospects are on the radar of large investment firms that have substantial resources and are more inclined to invest in later-stage, lower-risk projects. However, risk capital investors love to invest in the day after tomorrow, projects that are emerging, somewhat unclear but with significant growth potential in the future. These are the projects that investors love the most. If successful, they offer exceptional returns. Therefore, entrepreneurs must clearly forecast the trends in their industry, elucidate the past, present, and future circumstances, and explain any changes that have occurred. They should describe the opportunities they've identified, how they've recognized those opportunities, and the work they've done to seize them. The answers to these questions should be thought out in advance. The second point is about your unique skills or strengths. In simpler terms, it's where your competitive advantage lies. It's safe to say that every investor is concerned about this, specifically, what barriers the entrepreneur has established. Suppose another entrepreneur comes up with the same idea, raises the same funds, and hires a better team. Can you still survive? What if a larger company decides to enter the same market? These questions are both crucial for investors and challenging for entrepreneurs. These unique skills or strengths could be advanced technologies you've mastered, creating an entirely new product that makes it difficult for competitors to catch up in a short time. This can be considered a barrier. Another type of barrier is industry experience. For instance, if you're a doctor with decades of experience in the medical field, your knowledge and expertise can be a significant barrier that others can't easily replicate. One of the most common barriers is your team. It's about the advantages your team brings together. For example, the author, when starting a company, highlighted his strengths to investors. First, he partnered with a highly renowned CEO with an excellent track record in many large companies. That was an advantage. Second, they had extensive data analysis capabilities, providing a deep understanding of the current market landscape. This was another advantage. In essence, the most critical competitive edge comes from people, which is why the saying goes, you invest in people. Sometimes, when the right people are involved, even a mediocre idea can be executed to produce exceptional results. So, during your regular activities, accumulate your strengths. Nobody cares about your shortcomings, they care about your talents. Therefore, a barrier is something that isn't easy to create and requires significant effort to acquire. It's like a high wall that keeps competitors out. If you want to take the same path, you must first scale this wall. You might be as small as a hedgehog, but you must curl up completely to prevent competitors from taking a bite. That's the importance of barriers. The third point is about the execution ability of your team. In the past, investors mainly focused on the leader of a team, the person who came up with the idea, thinking that having a great idea was crucial. But now, many investors have shifted their attention to the second-in-command, the one who turns ideas into action. A good second-in-command can often resurrect a bad idea. Sometimes, the idea behind a startup isn't as important because information is now relatively transparent, even in an industry like investment that used to seem highly specialized. More and more people are entering this field, making it almost impossible to find an undiscovered trend. In such cases, the only thing you can do is run faster than the others. Take action, even if it means making mistakes that you can quickly correct. Therefore, action is a core advantage for entrepreneurs. How can you demonstrate your ability to take action? The answer lies in showcasing what you've accomplished in the past. What impressive feats have you achieved, how have you seized timely opportunities, and how have you left your competitors behind? These are things that can be demonstrated through the accumulation of experiences over time. So, entrepreneurship isn't something you can dive into on a whim, it's the result of long-term accumulation. In simple terms, if you're naturally someone who loves to take initiative, make sure to highlight this quality, as it can earn you extra points in the eyes of investors. Whether it's a business plan or a presentation, by addressing these 3 points, you're likely to win over an investment opportunity. In summary, this book has provided insights into the workings of angel investment institutions, helping entrepreneurs secure funds at a more efficient pace. Entrepreneurs need to maintain the right mindset, engage with investors on equal footing, pre-screen investment firms, prepare their materials, and choose the right timing for seeking investments. When preparing your business plan and communication materials, be sure to clarify your objectives, outline future trends, define your barriers, and demonstrate your team's execution capabilities. By presenting your entrepreneurial qualities, you have a good chance of winning over an investment project. Congratulations! You've finished listening to another book. Thank you for your support and attention. Please subscribe to the Tim Booker Channel audiobook channel. Give us a thumbs up and share it with your family and friends. Wisdom is meant to be shared, paving the way for a brighter future. Thank you, and goodbye.